One of the big things is that you maybe are forced to come up with your own thesis and not so much follow whatever the trends are at the moment. Right now we're in a big AI trend, and I would say 2 or 3 years ago we were in a big Web3 trend. And here on the ground, we're in a big businesses that work trend, and we've been that way for decades.
This is Net Learnings, the podcast that keeps finance and banking professionals ahead of the curve. In each episode, we focus on career growth and practical advice, while mixing in the occasional war story. Join us as we tap into the minds of leaders and experts at some of the world's most notable financial services firms and enterprises. Let's get started.
Hello and welcome to Net Learnings. I'm your host, Kyle Peterty. Today's guest is Marcus Whitney, healthcare VC, board member, keynote speaker, and best-selling author of the book Create and Orchestrate. Among his other unique credentials and accomplishments, Marcus is a world Master Jiu Jitsu Champion, a co-founder and minority owner of the Nashville Soccer Club, and he was recently named to Nashville Business Journal's Power 100 list for 2023. Marcus has no small feat. Congratulations. Welcome to the show, and thank you for joining me.
Thanks, Kyle. Really happy to be here.
First, maybe we can start. Can you tell us a bit about yourself and your firms, Jumpstart Health Investors and Jumpstart Nova?
Yeah, sure. So, I'm 47 years old and was born and raised in Brooklyn, New York, but have lived the last 23 years of my life in Nashville, Tennessee. So 2 pretty different places, but really happy to have been born and raised in Brooklyn and really grateful to have spent the last 23 years here in Nashville. We've experienced tremendous growth in this city. And there are many reasons for that. Some of it is, the incredible brand of Music City and the tourism that we've had here. Some of it is the fact that it's a no income tax state, so a lot of people enjoy doing business here. But our healthcare industry is a very, very strong industry and has been that way for more than 50 years. And so Jumpstart Health Investors is an early stage venture capital firm, and we're exclusively focused on healthcare innovation. So we invest in companies all across the United States that are innovating in healthcare and making things better for both the population that needs better healthcare, but also for the workforce.
Okay. So assume I'm the founder of a health tech startup and I'm going to market looking for a venture investor. This is your chance for a totally shameless plug. Why should I work with the Jumpstart Group of capital partners?
Yeah, so we've been in business for 9 years. We've invested in almost 200 companies. We've had great returns and great success. We are networked across the entire healthcare industry, whether you're looking for connections into health insurance companies, health systems, health services companies, health technology companies, or even brokers. We're very well connected across the industry. We've got a great platform for supporting early stage companies and specifically those founders called Jumpstart Insight that we've built over the course of the last 9 years, knowing what early stage founders really need from a support perspective. And also we have strategic healthcare companies as investors in our funds. So really great partners from HCA Healthcare based here in Nashville to Eli Lilly, fantastic pharma company, to Cardinal Health. So we're just basically, I think, the early stage healthcare venture firm for you to consider.
I like it. You mentioned you're located in Nashville, and it's interesting because that's not a legacy tech hub in the same way that like a San Francisco, Seattle, maybe Austin. What is the technology and maybe more specifically the venture ecosystem like in Central Tennessee?
Yeah, so we've had a really robust healthcare venture ecosystem here probably for the last 35 or so years. Really a derivative of the success of HCA Healthcare. Many of the executives left there. They made a lot of money and they invested in sort of what the next generation of healthcare would be. They were very knowledgeable about the space, about the regulatory issues around reimbursement. And so they were able to build the next generation of businesses. But for the most part, those businesses were not really technology businesses. They were really services businesses that those executives really understood through their HCA experience. From a technology perspective, we've really grown that, I would say, largely through attracting new talent to move here. So people come to Nashville, they love the quality of life, they love how friendly everybody is here. They love, or they used to love the low commute times, a lower cost of living. And so, we were bringing in talented people from the coast for, I would say, most of the last 10 years. And then most recently, as the city has really ascended to a top tier 2 city, we've been able to score some really great headquarter relocations. So Amazon has set up a very large base here. Oracle is setting up a headquarters here. Microsoft has expanded their base here. And so Google has a really nice presence here. So we've been growing, I would say, both through organically relocating individuals here, as well as bringing big corporate relocations here. So we're starting to really get some strength from a tech perspective, but certainly nowhere near what you would see in Silicon Valley, Boston or New York. That's still something we're really growing into.
Are there distinct advantages to being a player in the venture space in an area that's maybe not as built out?
Yeah, I mean, I think one of the big things is that you maybe are forced to come up with your own thesis and not so much follow whatever the trends are at the moment. Right now we're in a big AI trend, and I would say 2 or 3 years ago we were in a big Web3 trend. And here on the ground, we're in a big businesses that work trend, and we've been that way for decades. So I think we kind of stick to our knitting because we're not on the coast, and we focus on what do we do and what do we do differently and better than everybody else. And we just try to get better at that and continue to build that competitive moat here. So probably just not following the herd as much is one of the big advantages that we have.
Great perspective. While we're on the subject of being in Nashville, I have to ask, where do you land on country music?
So it's pretty interesting. My wife works pretty deeply in the country music and tech industry. She works at Spotify, and I'm actually on the board of the Country Music Hall of Fame.
Wow.
So I grew up in Brooklyn, New York. My sort of musical favorite genre is hip hop. There's no question. That's what I was born and raised on. But, being here for several decades, I've really learned to appreciate great country music, and especially I would say the songwriting aspect of it, really coming to appreciate just how clever and witty the songwriters are and how they're able to take all sorts of interesting life scenarios and emotions and put them into song lyrics. And so, I certainly have my snobbish opinions being on the Hall of Fame board about what good country music is versus what maybe a lot of the commercial fodder is. And I'm really into good country music. Some of my favorites are Chris Stapleton, Sturgill Simpson. There are some incredible acts out there.
Yeah, phenomenal artists. Let's maybe drill down a little bit more into the venture discussion, if that's okay. Venture capital, it's a buy-side function. It's a type of private equity, and that capital is being deployed to private companies as opposed to purchasing shares in like a public entity. I always think of venture as, if you think of like a PE funding scale, it's PE, but for earlier stage companies. But you're the expert. How do you characterize or define venture capital?
I think that's a really good description. I think just to maybe take it one step further, the maturity of the companies really changes the nature of the work that we're doing, right? So in private equity, you're dealing with very mature companies, and you're largely looking at financials and how you can optimize financials and how you might be able to roll up several mature companies into one that's more efficient because you're taking out some of the overhead and you're multiplying the effectiveness by maybe combining capabilities. At the venture scale, especially early stage venture, what we focus on, we're really optimizing to try to achieve product market fit. And so it's a lot more art than private equity, I would say, because you have to engage with the market. You don't achieve product market fit on your own. You have to engage with the market, and the market is a collaborator in the process of helping you find product market fit. And so as venture investors, we have to be, I think, pretty good at that process of achieving product market fit. I think we have to be good mentors and supporters of founders because they are working in the unknown, both in terms of what the future of the market's going to be, but also like the future of their business. It's not a clear going concern yet. And so, we have to be very supportive to those founders. And ultimately, we have to be able to underwrite risk, I would say, in a different way than private equity does. Very little failure is allowed in the private equity level. Your failure is basically maybe a lower multiple than targeted, but you generally can't lose money in private equity. That's not okay. In venture, you're going to have a reasonably high failure rate, across your portfolio. 40, 50, 60%, 70% sometimes of the companies will fail. That's not a failure rate I strive for or that I think is acceptable, but it is a working model that has generated great returns because many of the greatest returns ever have come from one or two companies in any given fund's portfolio that generate 100x their initial capital invested. So I would say the risk profiling, the actual activity of value creation, and the way that we support the founders and leaders of the company are three of the ways that venture is different from private equity.
That's really interesting perspective. And I actually did want to talk a little bit about sort of some frameworks and rules of thumb and things. And one of them was around portfolio construction. So I've heard venture referred to as a game of home runs as opposed to batting averages, which is sort of what you're describing. I think like a much narrower band of potential outcomes in private equity. And as you go earlier in the company life cycle, it becomes quite a potential range. And I guess sort of the rule of thumb you hear, you just alluded to it, is like, 3 to 4 zeros, some kind of 1Xs and some rocket ship returns. Can you maybe explain, so it's sort of a two-part question. I'd love to talk about the stages of venture, because even within the early, there's seed, there's angel, there's the alphabet soup of different series. How does that sort of profile change when you're very, very early? And what are those stages? It's a lot of questions in one, but maybe you can.
No problem. If I were to sort of draw some high level buckets, I would say there is early stage, late stage, and growth stage.
Okay.
Those are kind of the three big buckets in venture, and those aren't stages I've made up. If you were to go to pitchbook.com, that generates great quarterly reports on the venture capital industry, that's kind of how they segment the different stages into those three buckets. Growth stage looks a lot like private equity. At that point, these companies should be very mature. They're able to take on large capital investments at a time. So it would not be odd to see 30, 40, 50, million up to hundreds of millions of dollars invested in a company at the true growth stage. Later stage is really sort of the Series B to maybe Series D range, and that is usually going to be sub 150 million in terms of the size of the round that's going in. But still, more mature companies, they're clearly scaling at that point of their development. And there are also companies that I think should be well poised for an exit, whether that's a strategic acquisition or an IPO. Early stage is where we invest at Jumpstart Health Investors. And there are really sort of three stages in early stage that have definitive differences. So there's pre-seed, there's seed, and there's A. Pre-seed is kind of the first money after friends and family that could be considered institutional. So we have a fund family called Jumpstart Foundry. All it does is make pre-seed investments. It's been doing that for 9 years. It invests $150K in companies. Generally, they're going to be valued at $2 million. And it's a very standard investment model that we do there. And we invest in, 40 plus companies a year at that scale. So that's kind of the size of the checks that go in at the pre-seed stage. That's a general size of what the valuations might be. $2 to $4 million is kind of the right range for a pre-seed value company.
Okay.
Once you get to seed, now you're in the real game. The check sizes are getting more into the millions of dollars. I think right now the median round for seed was around 3.5 million in Q3 of this year. So that's kind of the size of the rounds. The valuations are kind of in that $10 to $20 million range. So you've got some reasonable value there. Usually those companies are generating revenue. So they have some level of product market fit, but maybe not the kind of product market fit you would consider scalable. There's still some stuff to figure out. There's still some product to build out, some team to build out there. And then Series A is the most mature of that early stage group. And those rounds are generally more in the 8 to 15 million range. Your valuations are more in the 20 to 40 million dollars of value there. And that's really the beginning of scale. Usually those rounds are used to sort of build out a more mature management team, used to really grow out revenue, harden maybe the security in the business or some of those more mature things that early on, they're almost not worth investing in because the company is not generating enough revenue. So those are kind of the three big buckets and a little bit of what differentiates them. What I would say is really changing in the market right now. You talked about, a game of home runs. We've had this massive rate of change of interest rates really driven by the Federal Reserve, at least in America, increasing the federal funds rate from 0% to north of 5% in a year's time. That changes a lot. It changes the way the public equities are valued, which ultimately ends up changing the way that private equities are valued. And then downstream of that, it changes the way that venture capital companies are valued. And so we've had a rewriting of the values of companies as a result of that raise of interest rates. While that has happened, the IPO market has largely shut down. So we've had very, very few IPOs over the last year and a half. And when you don't have IPOs, it's hard to get home runs, right? I mean, you know, mostly when we think about IPOs, we're thinking about home runs. So if you don't have an IPO market, then that means, does a game of home runs actually work in venture capital? And I think a lot of early stage investors are shifting their mindset to say, look, the game of home runs really might have been a zero interest rate era game. And in a 5% interest rate era game, maybe we need more hit rate. Maybe we need to expect our valuations are going to be lower. Less companies will get public. So, you know, less failure is allowable. And we need more companies to get to that exit at lower terminal valuations. So I think we're actually in the process of changing our narrative around venture being a game of home runs to venture being a batting average and hit rate game. I think we're very much in that process of changing that mindset.
How long would you say it takes? Because I would assume that the change in valuation and perception trickles down from the public markets to private equity to venture on a lag. And my understanding is that there is some stubbornly high valuation expectations from founders and certain funds. Did you find that in the market?
Yes, but we are now in the place where everyone is pretty much there. So, you know, the
How long
public
did it
markets,
take?
it took a year. The public markets priced in last summer, right? So they priced in immediately, which forced, you know, the big tech layoffs that happened in Q1 of this year. So all the companies laying off minimum 7% of their workforce. That happened in Q1. That was because the public markets were writing down the stock last summer, right? We just have had the private market write-downs really start to take effect, I would say, in Q2 and Q3 of this year. So we just have reports that came out from Carta and PitchBook talking about the 2-year valuation swings, especially in that growth stage category. Valuations down a median of 61%. Yeah, over 2 years.
That's staggering.
It's staggering, yes. Now the valuations in the early stage did not go down as much, but what we haven't been able to really quantify is how many companies died because they were not able to get funding. Deal volume, the number of deals closed, is down overall in venture capital at least 50%. So, you know, we've priced it in now. We've taken our lumps. Everyone has written down their books, and now we're trying to figure out how we create value from here.
So you sort of touched on this around the number of deals closing. One outside perception I've always found about venture is that they're deal junkies. It's super sexy. You're going out and finding opportunities and doing tons of due diligence and like all this negotiation. But I feel like there's this other part of the business too, and that's supporting and mentoring founders with the operational piece and understanding the product market fit, like you mentioned, helping them grow the business and manage risks. Acknowledging that this will vary from firm to firm. Like on balance, what does the actual breakdown of responsibilities look like? And was it different 2 years ago when deal flow was high rather than now? Or maybe are you doing a little bit more sort of like farming and close operational work with your portcos?
Yeah, let me work back from the variation in firms. And so, you know, I would say that different firms have different strategies, and those strategies come in many different aspects of the way that you operate your firm. One of those is going to be fund size. So how big is the fund? And then from there, you get into what size checks do you write? And then you get into, do you lead deals or do you follow? This is a big distinction. If you lead, you're setting the terms, you're almost certainly taking a board seat, and you're very leaned in and engaged. If you only follow, and there are many venture firms that only follow, then you come on the back of somebody that's led the deal, done all the hard work on the term sheet. You're probably not sitting on the board, and you're really just making an investment in the asset and then tracking its progress over time. So that's a really big distinction in how engaged you're going to be with the founder, right? And then there's just the general, are you into working closely with founders, or are you into just watching your investment? And that is a different thing from firm to firm. At Jumpstart, we are very much into working with founders. My background was entrepreneurship and technology. My partner was also an entrepreneur. So we have a lot of fun working with the entrepreneurs, and we get a lot of satisfaction out of helping them make sure that they feel like they're not alone in this. Like when we write a check, we're partners, and we want to make sure that they know that they can come to us with really hard things that maybe they can't go to their other teammates with, but we're here for them to talk through the hard things, because starting a business, growing a business, these are really hard things to do. Right before I was on this podcast, I was having one of my weekly 30-minute sessions with one of my founders. And that's kind of every Friday afternoon is mostly a bunch of 30-minute one-on-ones with the founders in my portfolio. So that's the way that we do it, and that's how we like to do it. We like to go into our board meetings having collaborated on what the board meeting will look like with the founders. So it's not like this, meeting full of surprises. We know everything before we go into the meeting. That's just our strategy, but it's not by any means a universal strategy, nor is it necessarily the best strategy to generate returns. I think funds need to operate in a way that best reflects the values and the strengths of the fund managers. So for us, we think mentorship is a strength, and so we do it, but some folks are just really, really good at picking deals.
Given that you work so closely with folks and you use the word partner, I love that approach. Of course, every deal and every team is different, but are there certain specific qualities or characteristics that you're always looking for in a founder, like absolute must-haves?
Yeah, for sure. I want to go back to that word partnership. If they can remember that we are ultimately partners and not treat us as somebody who they have to manage and keep certain information from, or only tell us the good parts and not tell us the bad parts, that's a huge deal. That's a huge deal. We can't have surprises. We have to have trust. We have to have a willingness to partner, and we have to have a willingness for them to listen and be coached. They don't need to take our advice 100% of the time. They are the management team. We are not. We get that. They're closer to the problem. But sometimes, having a little distance from the problem, or being able to see that same problem play out across an entire portfolio, gives you a little bit of wisdom and some perspective on what might be the right solution to the problem. So I think partnership with us as investors is one of the top things that we really look for. And honestly, has a lot to do with how we feel about our ability to continue to invest in a company, or to continue to effectively support a company, is what does that partnership look like? And then from there, I think they are going to have to be optimistic, because again, growing companies are really hard. Yep. So you have to be optimistic, not irrationally optimistic, but you have to have a positive attitude and a can-do attitude, and you have to be willing to work harder than everybody else. You're going to ask your team to work incredibly hard. They have to look at you as the model of what that looks like, and they have to know you're not asking them to do anything that you're not already doing yourself. That has to be sort of a built-in thing. So those are just a couple. I wouldn't say that's an exhaustive list, but those are some really important things to us.
Yeah, no, that's a really good list. For our listeners, we have a lot of listeners and members of the CFI community that call them sort of career curious, just looking to move up and be mobile. And for those that are considering a career in venture or making a move over, why might someone want to consider a career in venture capital?
I would say the most important thing about wanting to be in the venture capital space is that you really are passionate about solutions and creating value, because that's what we do. In venture capital, ultimately, we back businesses that solve problems and that should be a net positive for the world. I especially feel that way as a healthcare venture capitalist. Everything we invest in should be making the healthcare industry better, whether that's better outcomes for patients, lower cost of care, better access to care. And so, the people who work with us, they're impact motivated. They care. Hey, how many patients are we seeing across our portfolio? Have we resulted in any lives saved? Have we resulted in more affordable care? Have we resulted in a better quality of life for the caregivers, for the nurses, for the doctors? Are we making it easier for them to do the thing that they are doing to take care of our families and our communities every day? So I think impact has a lot to do with it. When you're in the finance world, there's obviously a lot of compliance and there's a lot of integrity that has to be there. That's critical in the finance space. But sometimes it can be a little bit, I don't know, it can just lack some inspiration, right? In terms of how am I really making the world a better place through my work? And I think venture is a way that you can both do finance, and you might be into finance. It's a way that you can both do finance, but also know you're really making an impact on the world, bringing new things, bringing new creative solutions into the world that can make things better.
How about a game?
Okay, let's do it.
All right, I think I'm going to do middle school money manager. So this is one we played before with some guests. I'm going to give you a list of words or terms or acronyms. They're going to be sort of in the venture space. And you have to give me your best explanation, but doing so as though I were in middle school. So it should be very, clear, very articulate. No, it's really easy on these calls for people to use way too much finance jargon. So you got to really simplify things for us.
See what words you picked.
Okay, yeah, let's see. Some of these are for my own benefit because I don't even totally understand them. Let's start with safe round.
Oh boy. Okay. A safe round is like an IOU.
Okay.
A safe round is like an IOU. So if we both want some candy, but you've got candy, and I would like some of that candy, I can write you this IOU, and you can give me this candy for now, and you hold that note. And at some later time, you can present that note to me and say, hey, remember that day when I gave you those 3 pieces of candy? This note says that a year later, you're going to give me 5 pieces of candy for those 3 pieces of candy. And I got to come up with the 5 pieces of candy. That's a good starter explanation for what a safe note is. It's a lot more complicated than that, but that's kind of the essence of it.
No, that was pretty good. I got to say that was very good actually. I've heard people use like lemonade stand analogies and so on. That was a good candy one's good. All right, liquidation preference.
Okay. Why don't we try to continue on with our candy metaphor since you like that and it was working?
Let's do it.
Okay. Let me think about how to do this. Okay. If you have been learning how to make cookies with your mom,
okay,
and you're feeling really positive about how good these cookies are, and you think you can sell these cookies to people on your block. You think you can make money to sell these cookies on your block, but you don't have any money for the ingredients. Okay? You have no money for the ingredients. You need $20 to be able to buy all the ingredients so you can make these cookies and then walk door to door and go sell those cookies. Okay? So I give you the $20 to go to the store and buy all your ingredients. And then you make the cookies. But the deal is, when you sell those cookies, and let's say there's 20 houses on the block, and you're going to sell each cookie for $2, 1 cookie per house, okay? That's going to make you $40, right? 1 cookie for every house, 20 houses, $2 per cookie. That's $40. When you collect that $40 and you're totally out of cookies and you come back, before we split the $40, you have to give me my $20 back.
That's the preference piece.
My $20 has to come back to me first. Then we have $20 left and we split the $20. That's liquidation preferences.
Sounds like a good deal.
Well, hey, I put my $20 in.
That's right, yeah.
I need my $20 back.
That's fair, yeah. No matter how good the cookies are. I get it. Okay,
no matter
that's
how good
another
the
good
cookies
one.
are. Yeah.
That was another really good one. Okay, I'm looking at my list here, and I feel like we'll hire you. You can explain finance topics really, really easily. This is great.
This is pretty hard, I gotta say.
It's pretty hard. These aren't
this.
easy words. I picked hard words.
No.
Okay, well, we'll do one more hard one. Vesting.
Vesting. Okay, we can do vesting. Yeah, we can do vesting. Okay, let's think about vesting.
About cookies. I don't know about you.
Yeah, no. Let's think about vesting. Yeah, I think we're good. We're gonna stick with cookies. Okay, we're gonna stick with cookies. All right. So, here's a way to think about vesting. You are being recruited by your parents to rake the leaves in front of the house. Okay, you got to rake the leaves in front of the house, and instead of just thinking about it on a day-to-day or a week-to-week basis, they want you to really care about doing it for an entire year. Okay. They want you to think about doing it for an entire year. So what they do is they say, okay, we're going to give you an awesome batch of cookies, and we're going to give you a cell phone.
Right on.
But we're going to do that in each season, and we're going to kind of break it up, and things are going to get better as we get closer to the end. So for your first season, let's just take, winter.
Mm-hmm.
For your first season, you're going to get a couple of cookies. Then when spring comes, you're going to get 4 cookies. In summer, you're going to get 8 cookies. And then in the fall, you're going to get that iPhone. But if you stop in the spring, you get your 2 cookies, you get your 4 cookies, but you don't get your 8 cookies and you don't get your iPhone.
That's it.
If you stop in the summer, you get the 2 cookies, the 4 cookies, and the 8 cookies, but you don't get your iPhone. And most importantly, you don't get to stop in the spring and the summer, but then come back in the fall and get the iPhone. You have to do it continuously, all the seasons, to get that big prize. But it's yours. It's guaranteed. All you have to do is rake the leaves every week.
All year.
For an entire year. It's guaranteed that there's no take backsies. Your parents cannot deny you at the end. It is guaranteed you're getting the iPhone. But you have to rake the leaves every single week for a year. That's vesting.
Love that. That's vesting, all right. And I think I would even take ownership over cleaning the yard if that were the case.
Yeah. Well, that's the whole point, right? Make the incentives worth it.
Precisely. That's awesome. Thank you for those. Those are great.
It was a fun game.
I'd love to transition into talking a little bit about your book and some career type wisdom that was in the book. I love it. Actually, I got the e-version. As a parent of several young children, sitting down and actually reading a book is not a thing for me anymore, but I can certainly listen to a book while I'm doing dishes or driving or what have you. So I'm not myself an entrepreneur, but I see tremendous value in the lessons that you shared in the book, Create and Orchestrate. And it was about your entrepreneurial journey largely. And the recommendations you make, even just as like professional employee, I think there's tons to take away. Now, I don't want to give away everything. Obviously, I encourage our listeners to actually go out and purchase a copy because I think it's a great book. But if we could maybe go through just kind of a few topics that you covered, and then you could weigh in on them like directly from the author. Does that work?
Yeah, that's great. Let's do it.
Okay, so the first one that I found fascinating, and I think you didn't come up with this, but you spoke eloquently about it, was the 4 burners theory. I think that was family, friends, health, and work. What's that all about?
That's right. Yeah, so it's a recognition that you have limited time and you have limited energy. And there are trade-offs. Probably the easiest way to put it is there are trade-offs. And so everything can't be the main thing. And those 4 burners that you just mentioned, friends, family, health, and work, are kind of like the 4 core components of life, right? I mean, you may have more things in there, especially as you think about things that are just for you, or you think about your community, those might be other burners. But for most people, friends, family, health, and work are kind of the 4 cornerstones of life. And we've all had periods where work kicks up, and unfortunately, one of those other 3 burners has to take a hit. What is it going to be? Are you going to sleep less and eat worse? Well, then that would be health, right? Are you going to have to tell your friends, hey, I'm not going to be able to hang out this month because work is kicking up? Okay, well, that your friend's burner will get turned down. Sometimes, and we hear plenty of times about how family, misses out, where you miss things with your kids or you miss time with your spouse. And it's just this recognition that you are working with the same 24 hours in a day, every single day. And at different times, different burners will require more from you, and you're going to have to trade off other things. I think some people get frustrated at the inevitability of this. And I think the point of the 4 burners is to just give you a visual to sort of understand if all 4 burners are on high, you're going to burn something.
It's going to be a crappy meal. You can't cook.
It's going to be a bad
burners.
meal.
Yeah.
You can't cook. So you probably are going to have to focus on something like 2 at a time,
right,
and really get those dishes right, and then maybe transition to the other 2. So it's really just a metaphor for thinking about your time, your focus, and how effective you can be at any one thing or any 2 things at any given time.
Yeah, I think there's probably value in just understanding the framework, and that it's real and that it exists, right? There's no necessarily science to it. You also talk about the idea of not self-qualifying, right? So you spoke in the book about your journey to becoming a computer programmer and removing terms like aspiring or entry level. Can you expand upon that?
Yeah, I mean, for me, I have found that identity is an incredible driver of habit and of behavior. And so if you want to have certain habits and certain behaviors, it's very, very helpful to first work on your identity. And so in the book, I was talking about my transition from being a college dropout who was waiting tables, a waiter, to a programmer. And I was not a professional programmer, meaning no one was paying me at the time. I was not a very experienced programmer, meaning I didn't have years of experience underneath me. But I wanted to make sure I was doing the things that programmers did. And so as opposed to calling myself an aspiring programmer, which you can be aspiring forever, I just said I'm a programmer. What do programmers do? Well, programmers study, and programmers practice, and programmers build things. And so I went about just doing those things. Didn't matter that I hadn't been paid to do it. Didn't matter that I wasn't that experienced. But I think that had a lot to do with it only taking 8 months for me, in a self-taught situation to switch to becoming a professional programmer and getting my first job. And I think it wasn't just some like law of attraction thing. It was, I avoided any qualifiers that would have limited my habits and my behaviors, getting me to where I really wanted to go, right? So it's just an understanding that self-qualifying can have a really negative impact on the choices you make and how you spend your time, and can actually delay the progress that you're seeking in transitioning and becoming that thing.
It must have a profound impact on confidence overall.
Yeah, for sure. I mean, I found it to be an incredible lever in life. As you were giving my intro earlier, you talked about me being a world Master Jiu Jitsu Champion, and I've only been training Jiu Jitsu for 3 years now. To be fair, I was a wrestler in high school, and I have a background of being on the mats. But I think there was a lot of fear that I had to overcome to get to the point where I was competing again, especially, in my 40s, and dedicating the kind of practice time and doing so with, very, very young people on a regular basis, kind of being the only 40-something, training 7 a.m. in the morning with a bunch of 20 and 30-somethings. And a lot of that was just me making the decision to identify as an athlete. Full stop. I saw myself as an athlete. Well, what do athletes do? Athletes, athletes get trainers, athletes get nutritionists, athletes put in the time, athletes focus on their sleep, athletes study whatever the sport is that they're working for. They spend time in the tape room. And I did all of those things. And then the result was, winning sort of the biggest tournament that I can win at this stage of my life, twice now, 2 years in a row. And I think that's entirely credited to my identification, as an athlete, right? Not saying, oh, one day I want to be, or I don't know, at this age, and just saying, no, I'm an athlete. And then what do athletes do? Do the things that my identity calls on me to do.
Yeah, that's powerful. In the first chapter of the book, you lay out a really interesting analogy. I'm a former sports guy, fallen off a little bit over the years, but it was between sports and entrepreneurship. And the idea, like the statistical probability of children ever making like the major leagues or playing a sport professionally is minute. And you talk about how even knowing that, we don't pull our kids out of little league or out of youth sports, right? Intuitively, as a society, we understand that the lessons they learn will be very valuable throughout their lives and their careers. And you asked rhetorically, what if we approached entrepreneurship the same way? Like, what if we taught children about entrepreneurship and gave them opportunities to live it and breathe it, even if they never actually become entrepreneurs? Would you expand on that a little bit? I thought it was fascinating.
Yeah, I mean, look, I think that there are plenty of young people that are able to make it through their youth because sports exist.
Yeah. Oh,
right.
Yeah.
They may not be great in the classroom. That may not be what they're going to grow up to be. And they may not also grow up to be professional athletes, but sports gives them a space to grow, to learn leadership skills, to learn team building skills, to learn rules, to learn sportsmanship. And in many ways to also learn things like math. Like sports is a place where math is very applied. So I think there are all sorts of lessons that millions of young people have learned in the world from the theater of sports. Entrepreneurship, I think, speaks to a certain personality type. I talk about it in the book as ambitious creative rebels. And I think a lot of kids who may not necessarily take to sports and are in school and maybe get in trouble because they also don't take to the structure of the way that classes are set up, they don't have the benefit of having the entrepreneurial theater where they could thrive and be successful. And I think many people who have been very successful entrepreneurs, because they have that rebel in them, could have very well ended up being criminals, and I don't say that as, entrepreneurs are criminal minded.
Right.
It's more, they're not necessarily oriented around the status quo.
Well, they like to break rules, right? The most successful ones tend to break the status quo.
Exactly. And thankfully, the reality of the free market is that it not only celebrates, but it rewards those who seek to break the status quo, in the effort of making things better. I mean, I think about a lot of people who were class clowns, and it's like, look, they had an objective. They were trying to make, their friends happier. They were trying to make people laugh, now, they were also being disruptive. We celebrate disruption in the entrepreneurial space and in the free market, but we put you in detention for being disruptive in a classroom, right? And so I just think that there are millions of young people out there who would really benefit from the opportunity to be exposed to and understand that entrepreneurship is a real viable path in the world. And quite frankly, as they grow up in the world, they're going to grow up into a world that is run by entrepreneurs. Yeah. I mean, is there any doubt that what we're doing right now, recording this podcast, is not enabled by an entrepreneur? Is there any doubt that Elon Musk has more power than almost any human has ever had at any point in the history of the world right now? And ultimately, that's not just because he's a scientist; it's because he's an entrepreneur. So, we're missing that. And my point was just sort of calling out that we're doing a disservice to our young people to not properly expose them to this thing that will be an inevitable thing they'll run into in their lives.
Yeah. No, I thought it was incredible. One more was the time budget. I'm paraphrasing, but I think you said something like it's your responsibility to manage your time as you would manage your money in terms of like investing it wisely. What's your secret sauce?
Well, I think just coming to the place where, as an axiom, I've understood time is my most valuable resource. There's nothing more valuable than it, and I don't get any more of it than I currently have. And so I think from that perspective of valuing it highly, even more highly than money, I'm then much more judicious in how I spend it, and see it as a true important responsibility to manage it appropriately. And then understanding that there is a skill to managing your time well, and the better that you manage your time, the more you can get done, and not only necessarily the more you can get done, but you can make sure you get done the things that really matter to you. It's hard to get really big, important things done if you don't know how to manage your time. So I think it's critical for entrepreneurs who are going to have so many things they're going to be focused on to understand how to prioritize their time, how to manage their time, and how to protect their time. Right. And that's why I think the concept of budgeting time and making it analogous to money, because you do all of those things. You manage your money, you protect your money, you're very thoughtful in how you spend your money. And some of it, some of your money is kind of fun time money. Some of your time should be fun time. Yeah. But, for the most part, that comes after making sure you're paying your mortgage or your rent, and making sure you're paying any critical bills so that you don't get a bad credit rating, and making sure you're able to feed yourself, and making sure you're able to pay your taxes. The must-dos come first, and then you get the fun time after. The same is true of time, Yeah.
Marcus, what's the biggest regret of your career? Do you have any?
I generally am a windshield, not a rearview mirror kind of person. And I also have a general philosophy that I wouldn't be who I am now without all the experiences that I previously had. And so regret usually makes me feel less grateful for what I have today. And I don't love to do that. I can certainly look back on ways that I behaved and say, I'm a little embarrassed by the way that I behaved, not necessarily regretful if I learned from it. Right. And I think there were times where I wrote about it in the book, the chapter about press. There were times where I was not clear-headed about what was the most important thing in my role as a leader of a company, and not being focused on making sure the company was successful for the betterment of everyone who was pouring their blood, sweat, and tears into the business, but focused on accolades from a press perspective. And those were tough lessons, but they're lessons that have stuck with me. You know what I mean? Ever since that's happened, I've certainly been in the press, but I don't really care much about it. I only really care about how my businesses are performing. But there was a time where I was really obsessed with that because I was younger and just less mature, and that's just the reality of it. But generally, I like to steer clear of regrets because I am the byproduct of all of my past experiences, and mistakes are inevitable.
Yeah, that's a more terrific perspective. Where can our listeners go to learn more about you, your book, or your companies?
Well, you can go to marcuswhitney.com, and from there you can certainly, see where my book is, get links to either listen to it on Audible or buy it on Amazon or Barnes & Nobles or anything like that. So marcuswhitney.com is where you can find out more about me, but also about the book. And I also do speaking, so if you were interested in that. And then if you were interested in learning about our investment platform, Jumpstart Health Investors, you could go to jumpstarthealth.co. That's .co, not .com. So jumpstarthealth.co, and you can learn about our various funds, our entire team, and everything we're doing in the health space.
Terrific. We're coming up on time. This has been a terrific chat. I can't thank you enough. I really appreciate it. There's one question I try to ask everyone, and that's, what can I do to help you? Or what can our listeners do to help you?
Oh, well, listen, you reaching out to ask me to be on this podcast is incredible. So I think you've already done your work. So thank you for having me on the show and allowing me to share, just my life's perspectives on these various topics. I really appreciate that. We do have a podcast for anyone who's interested in healthcare innovation that's called Health Further. And if you're interested in hearing me and my partner Vic talk more about healthcare innovation and the finance world and how all these things kind of come together, then I would say subscribing to that podcast, Health Further, would be great. But that's kind of it.
Okay. Listen, thank you again so much. Really appreciate your time. All the best.
Thanks, Kyle. It was a blast.
Thanks.
Thanks for listening to this episode of Net Learnings. This podcast is powered by CFI, an organization on a mission to enhance the skills, knowledge, and productivity of finance and banking professionals. If you enjoyed what you heard in this episode, make sure to follow Net Learnings wherever you listen to your favorite podcasts, or visit us online at corporatefinanceinstitute.com/podcast. See you next time.